Thank you very much for that kind introduction. And yes, this is the one strategy that every options trader needs to master. Okay, it's gonna you want to get the wind at your back, and by doing that, you need to define your risk, lower the risk as much as you can, but then still have an opportunity for profits. Okay, so it's that right mix that'll keep your account growing and growing throughout. All right, you just want to get this out of the way that Options Authority, we're solely an educator providing training on the theory of analyzing financial markets. We're not a registered investment advisor, and we don't offer personalized trading advice, okay? All training of our training is based on theoretical analysis of markets and theoretical examples of how someone might choose a trade based on theories taught by Options Authority. And just remember that you are your best risk manager. Okay, absolutely. You know how much money you have, you know how much money you can put at risk. And if you're looking at some basics, just some pamphlets, the Options Clearing Corporation, the Securities and Exchange Commission, and FINRA all have pamphlets for the basic terminologies. Okay, and we just want to say our personnel may own positions in or trade in the securities mentioned in the information that we provide. But all employees of Options Authority are prohibited from engaging in any transaction that directly or indirectly competes with the known interests of our subscribers. So we're not going to front run anybody, or we're not going to recommend something so that we can get taken out of our positions. Okay? All right, and it's kind of already told about that. So just want to give a little overview about our firm. We have I'm over 30 years of experience, about 35 years of experience in option trading. Well, we have other mentors that are equally as experienced as I have, and they're able to share their knowledge with you. In our option mentoring program, we have an extensive program that gives students a trading foundation that can be used for a lifetime. Okay? Just like riding a bicycle, once you build up that muscle memory, you're going to be able to trade options until the day you die. Okay? We teach them how to master the fundamentals of option trading up to the most advanced trading strategies. It happens over about a 6-month period of time. And they get a simulated trading environment with real markets. So, okay, so they learn how to build and adjust their positions. Okay. All this is done in one-on-one environment. Okay. It's done through one-on-one online. Each session is recorded. You get to keep it for your lifetime, and this is how you build up, like I said, that muscle memory. So you're going to be learning how to trade, okay? And you're learning from some of the best traders who have had experience for literally decades, okay? By the way, we have a couple different subscription products that we're offering for free 30-day trials, okay? The weekly options workshop, that's where we meet every Thursday at 1 o'clock Eastern time. It's led by me. It centers on how to place, monitor, and adjust live trades. It includes trade alerts delivered throughout the week. Okay? And we also have Options Marksman. This is a real-time recommendation service managed by an industry vet, John Lewis. It includes an average of 6 option trades per month and a weekly trading report. So, you know, just 30-day trial, okay? It's no obligation. If you don't like it, you know, don't go forward. But I tell you, that's you're getting a lot of experience with each one of these things, and it's why not take a month's flyer on it, okay? Okay, we're going to look at what actually is the one option strategy, okay? And then we're going to look at what are diagonal spreads, okay? When should we use them? What are their benefits? And when is the best time to use them, okay? Okay, so first up, I just want to say that you sell the same type, put or call, okay? So there's 2 types of options, puts and calls. Calls potentially become long stock, puts potentially become short stock if you exercise each one of them, okay? And that's in one expiration cycle, okay? So if it's a for instance, the October weekly, or April weeklies, for instance, okay? And then you buy the same, you're going to buy a call, but it's going to be in another expiration cycle, okay? So I don't know how familiar all of you are, but this combines the elements of a time spread and a vertical spread, okay? When should we use them? Okay. You don't want to do it when you're selling, when you're doing it with situations where the option that you sell, news events are not happening with the option you sell, okay? You don't want that to be taking place, okay? The reason is because there's two halves of this spread, okay? The option you sell is going to be nearer to expiring, and therefore it will lose its premium quicker, okay? And then preferably, although not always, you want news events that are happening with the options that you buy, okay? And because of that, it's not going to decay as rapidly. You want to trade stocks that are volatile, but not too volatile. And we'll get into that later when we get into the examples. If you're trading a stock that's volatile, there's going to be some higher premiums for the option premiums are going to be higher for the more volatile stocks, okay? But if it's too volatile, it's going to move outside the range. Once again, we'll show the examples of that, okay? Selling is decaying faster than the option we are buying, okay? So I'm just going to show you an example of that right now. Okay. All right, so here's an example of and 208.90. So we'll look at the 209 options, okay? And this thing right here is called theta. That means here's the option. It's $1.34. This is saying that it's going to lose about 9 cents between today and tomorrow. Okay, so theoretically, all other things being equal, this will go down to $1.25. Okay, this is the April one. Now we look at May. Same option, same strike price. It's about half of the decay rate of decay. Okay, so we want to sell the option that decays more rapidly. Here's a way to think of the decay in an option. When you take an ice cube out of the refrigerator, okay, you put it on the counter, it might sweat a little bit, okay? After about 5 seconds, a little sweat on the end of it. But then you come back a minute later, it's getting towards the end, you can actually see it vanish. And that's the way it is with the option premium, okay? Options are terrific, okay, because they give you so much leverage, but you have to keep in mind that they're wasting assets, okay? So you want to construct a position where part of it is wasting away and the other half is not, okay? All right, so the benefit of this is the option we're selling is decaying faster than the option we're buying, okay? All right. Okay. And you can make money in either direction, okay? And that you have a position that you can pivot off of, okay? Adjustments can readily be made. That's the key ingredient right here, all right? Probably 90% of your profits, if you're a knowledgeable options trader, comes from the fact that you're making smart adjustments, okay? Rarely do things you put on a position and just works perfectly, okay? I wish that was the case. I've been doing it for 35 years, and I can tell you that's not the case. Occasionally it will, but for the most part, you got to tweak things a little. All right? So when is the best time to use them? Okay. That would be upcoming earnings reports would be a good one. Okay. That's where the options you're selling are going to be potentially be very overinflated. We'll give a few examples of that. We're going to give you some examples of trades that actually happen, and then we're going to give examples of trades that you might be interested in. Okay. Takeover stocks is another one. Okay. Once again, you're doing two different strike prices. Okay. And if a stock actually is taken over, then the options in each month are going to be priced the same. Same strike price, same thing. So that might be a disaster if you pull, not necessarily a disaster, but that would go against you if you establish one of these positions. But it might be giving you so much edge on that that you can't walk away from it. All right, it's kind of like the way to look at option trading is, my wife works for an asset manager, and there's about 80 employees that were involved in the pool that they had, office pool, and everybody, probably of the 80, probably 60 had Kentucky to win, and she wanted to put Kentucky as the win. I said, there's no way you can win. They're 2-to-1 underdogs, so, which means they have a 33% chance of winning it all, and 75% of the people are going along with them, are betting that they'll be the ones. Okay. Now I kind of thought Kentucky would win it all, but there's no way you can. The odds just aren't with it. You have to be better than all those people that picked Kentucky. So I said, pick Duke. The way I said, take Wisconsin beating Duke in the final. Well, I looked good for a while when it was up by 8 points, but it wasn't. Did I really think Duke would? I mean, Wisconsin would beat Duke in the final? I didn't, but that's what the odds told me to do. That's kind of what you have to do with options. Okay. And the third thing is you want to look at, for big differences in the implied volatility between the expiration cycles. All right, I could probably do a huge 3-hour class just on webinar just on implied volatility. Okay, so without saying too much about it, what implied volatility is, it's a price level for premium. Okay, so if the stock's at a certain point and the premium for each option is a certain point, if it's $2 one day and the stock's at the same place and then it rises instead of decaying, that means there's a greater demand for these options. So the implied volatility is moving up. Okay. If the premium declines faster than the decay figure that I showed you before, that means implied volatility is declining. So that's a key thing you have to look at. Okay. All right. And is everyone following? If you have a question, feel free to fire it out to me. All right, and then a little while ago I told you that a diagonal trade was two different trades on the same stock, a short call paired with a long call. Okay? You start out, you look for something to sell that's nearer term to expiring. Okay? And you pair it up with a long call that will give you a hedge against that. Okay? I'm going to run through a couple sample trades, so get out a piece of paper and write this down. Okay? All right, so we're going to start up by selling 20 Feb 47.5 calls at $2.50. Okay, and when I say $2.50, that's per share. That's how you quote options prices. It's $2.50 per share. Okay, so you just take this one and over there, and it's now $250. That is $2.50. Is really $250, but quoting it, it's just $250, they say. Okay, and you sell 20 of these Feb 47.5 calls. Okay, so 20 times 250 is $5,000. Okay, that's the maximum possible profit. When you're trading options, the most you can make is when the option goes out worthless. And when does it go out worthless? When it's at the strike price or lower. Okay. All right, so it's strike price or maximum profit 5K at 47.50 or lower. Okay, because nobody's going to exercise a call if the stock's at 46, and if you can buy the stock at 46 and a half, you're not going to exercise the 47 and a half call. Okay? So this position is strictly bearish. Okay? The break-even point is 50. How do we get that break-even point? Okay? Anything 47 and a half or lower, calls go out worthless, right? Okay? All right? So we take this 47 and a half and we add it to the 250 and we come up with 50. All right? Because if you are short those calls and get assigned on them, that means you are obligated to short that stock at $47.50. Okay? Let me see. Or lower. Okay. So you're obligated to do that. So that's your basis for being short the stock. But remember, you collected a $2.50 premium for that. Okay. So for that obligation, you get paid for that obligation. Okay. So $50, anything above that, you lose money. And your maximum possible loss is unlimited. Okay. Because theoretically, stocks can go up forever. All right. And here's what it looks like. Okay, so we get this $5,000 right here. Okay, at $47.50 or lower. Okay, we can't make anything more than that $5,000. That's our maximum possible profit. Okay, and then we just keep losing money. Here's our break-even point right here, that 50 that we talked about. Okay. And then we just keep losing more and more money down as the stock keeps going up. All right, so it's wonderful if it stays below 47 and a half, right? But it's very, very dangerous. Okay, you don't want to be naked short options. Okay. All right, so we're going to start out with another half of the equation. Okay, and what that other half is, we're going to buy 24 of them. XYZ March 49 calls at 250. Okay, and just like when you shorted a call, the maximum losses are unlimited. Okay, just if you buy a call, your profits are unlimited. Because theoretically, the stock, there's no limit to how high it can go. All right, I was a market maker in Cisco in the 90s and early 2000s. And it didn't go up infinitely, but since I was in there at the beginning, it probably went up 100-fold, I think. I mean, it really just kept going up and up until it stopped going up and up. It's been kind of a dead stock the last several years. All right. The maximum possible profit unlimited, this position is strictly bullish. Okay. Break-even point is 51.50. So once again, you exercise it. Your basis for owning the stock is at 49. But you had to pay this $2.50 premium for it. Okay, 49 plus 250 equals 51.50. All right. So the maximum possible loss on this end is take 20 times 250 is a 5,000 still, and then you have an extra 4 times 250, so 6K. All right. And that happens anywhere 49 or lower. Okay? So. And here's the graph for it right here. Okay? Here's the 6K right there. Okay? Lose that constant amount. That's a good thing about being long options. You have a defined risk on what you can lose. All right? You can so much more so that if you were to buy 24 shares, 2,400 shares at 50, okay, just 100 shares would be $5,000. Okay, so that'd be like $120,000 you have to come up with if you wanted to buy an equivalent. So you get to buy these 24 calls and have the same, and you're putting out $6,000 instead of 120. So 20 to 1 differential. Okay. And then you can see the 5150 is the break-even point, and from there on up, unlimited profits. Okay. Okay, so now we're going to put them together. All right. So remember we sold the 20 XYZ 47.5 calls at 250, while at the same time buying 24 of the March 49 calls at 250. Maximum profit probably occurs at 47.50 on the February expiration. Now you're probably scratching your head and going, probably, what's this guy talking about? Every other option thing I've said, they lay out the graph and it shows exactly what happens. Okay, remember there's a difference. Not only is there a difference in the expiration cycle, March versus February, but there's also a difference in the volume. Okay? 24 of the March 49 calls versus 20 of the Feb 47.5 calls. Okay? So that difference in the volume, so what's the probable ideal situation would be if it goes out right at 47.50. All right? At 47.50, okay, what happens at February expiration? The options you're short go out completely worthless. All right? Now at 46.50, they'll also go out worthless. All right? But guess what? The calls you're still long are going to be worth less at 46.50 than they are at 47.50. If it starts going above 47.50, then you're dealing with a situation where that's going to go up, and it's probably going to move a little bit faster. The price is going to go up a little bit faster than the options you're long. That's why you need to buy these 4 extras, because when a call is more in the money, has a lower strike price, it's going to move more rapidly in price than the higher strike price. Okay, so that's why we needed to buy these 4 extras as a buffer against that upside swing. Okay, but if it really did, like, just exploded, okay, you would have, if it like doubled in price, these extra 4 would make up the difference and the difference in the strike price here. Okay, so in all likelihood, 47.50 is your sweet spot. But you know, if it made some giant move, it would actually be either one. Okay. And here's what the graph looks like. All right, right there, 47.50. That's what we want. But then you can see here, if it gets to a certain point, keeps moving up, then it's going to be higher than that. Okay. So we're going to look at a few examples of trades that have been made. Okay. Here's one where sell to open. Okay. 25 of the Apple Feb 119 calls at $2.06. All right. So these obviously at 20th of February they expire. Okay, and then 4 weeks later the March calls expire. All right. So even though it's $1 higher in strike price, you know, as I said before, the lower the strike price of an option, the higher the premium is going to be. But since we get that extra 4 weeks, we're going to have to pay for that extra 4 weeks of time. Okay. And so sold 25 of the Apple Feb 119 calls at $2.06 and bought to open 25 of the Apple March 120 calls at $3.30. Okay, so started out with that, and then the market started moving up. All right, and like I said before, we're selling these lower ones. They're going to start moving more rapidly to the upside than these. Okay, so we had to do something to counteract that. So I established this trade here to buy the Feb 110 120 call spread. Okay. So getting long the 110 calls and giving somebody else this gives us the right to get long at the stock at 110, while we're giving somebody else the right to get long at 120. So we collect a premium here, we pay a premium there. All right, so it's about $7.42 is the price we paid for that. If it kept rising above 120, it would go all the way to $10. Okay. So if we're losing on this spread on this side, 3 times 258, okay, we'd make about $800 on this, all right, if we started losing on that. okay? So once again, we're hedging, all right? We're always looking to hedge. All right, so what did we do? We took part of this spread off, all right? And started moving up towards that 119 area. And if it shot past there, even with the extra spread we had on, we get burned, okay? So we bought in our short 119 calls at 251, okay? And we sold the March 20 calls at 415. Okay, we did that 11 times, all right? So we still had plenty left, okay? So we gained about 440 bucks on that one, okay? Started moving again against us and pulled the plug. Didn't quite get the profit we did on the first half of it, okay? So we made about, let's see, 804 bucks, all right, by closing out the original spread that we had on. Okay, we still had that 3-lot spread though, okay? And what do we do with that? Okay, fortunately, we were able to make 60 bucks on this. All right, usually when you do something like this, the hedge you're doing, about at least 50% of the time, you're going to lose a little money on this, but it allows you to stay in the other trade that makes you money, okay? Since the time went by on this as well, okay, and there was more premium erosion on the 120s than the 110 calls, all right, we were able to make money on this. Okay, so the total gain of 864, only made 60 bucks on this. Had we stuck with this, it actually did go up to a full 10 bucks. We would have made, you know, another 750, 800 bucks. Well, you know what? You're never going to be right about everything, okay? So 864 bucks, I think the margin was about 3,500 on this trade, okay? So we're committing $3,500 to make $864. And it was done over about a 10-day period of time. That adds up to a 913% annual percentage rate of return, okay? That works well. All right, I know a lot of people see these things where, you know, you can make 900% a day for 2 weeks straight and all this stuff. Having been a trader for 35 years, I can tell you that's not real likely to happen. Okay, in fact, it's highly unlikely to happen. But if you can take a trade like this, $3,500, you stay in it for 10 days, it's not unrealistic to think something like this can happen. Okay, and if you can keep doing this, obviously, you wouldn't be able to do this on every trade, or you take your $30,000 account and turn it into 200. So not that it isn't possible, it's definitely possible, but it's not a bank on. Okay. Well, once again, we were spread the whole time. We're not going to blow out our account on one trade. We don't want to do that. Okay. And now we look at a Twitter trade. Okay. So we started out selling the Jan 36 calls at 124. All right. Okay. And we bought to open 20 of the Feb 37 calls at 256. All right. So you look at this and you go like, geez, this is a dollar strike price lower, okay, and we're selling it for about half the price, okay. Once again, it's because you have the extra time, okay, for something to happen. So you're going to have to pay extra for the further out option. That's just the way it is. That's what time value in options is all about, okay. So they slap this trade on for $1.32, okay. Okay, and then time passed by, made about 150 bucks, made 15 cents on this. So once again, 15 cents is $15, okay, times 10, and we made 150 bucks on this. All right, and we still had half the spread to go. once again, we want it right at this 36 level is where we're going to really hit the jackpot. Okay. Okay, so we did it, and it actually jumped hard. Okay, I forget who it was, Icon, or at the time, started buying a good chunk of it and had to disclose it, and all of a sudden Twitter shot up. I think it went up to 38, 39. Okay, so this actually was bleeding a little bit of the profits that we did. We were probably down about $100 or so. It started to pull back. Okay, when it did, I pulled it off right here, the remainder of it. Okay. So for 133, okay. So just $1 10 times. Okay, made a big $10 on that. All right. The idea is, though, I could have lost about $300 on it. Okay, had I not jumped to attention and say, okay, this is going against me. Sure, I made 150 in the first part of it. I'm not going to wait around to make another 150. I'm happy to make the $10. Okay. So once again, net gain of $160. It was a similar, like about 3K was the margin on this. Okay. And made $160. I think it all happened within a week's time. So for a $3,000 investment, you can make $160. That's actually not, with today's interest rates, you know, that wouldn't be bad. Just for, I think, a certificate deposit, it probably beats that 5 times over. Okay. But this is a week's period of time, so it's a 277% annual percentage rate of return. Okay, so when you think like, geez, I committed 3,000, I only made 160. Okay, but you're managing your risk. That's the whole thing. Okay, and it's a 277% annual rate of return if you can do this. All right. Now we're going to look at another trade that we did. All right. Buy to open 33 of the Feb, the April 17th, April 80 calls at 177 and expire on the 17th of April. Okay. And once again, we sold the nearer term options. Okay. That expire on the 21st of March. Okay. So it was like 4-week differential. Okay. Obviously, we had to pay, even though it's a higher strike price, we had to pay more for this. All right. So what we did originally, we bought 10 of the March 79 calls. Okay. So it's 75 cents. Okay, bought those back at 75 cents. And sold out 10 of the April 80 calls at $2. Okay. So we wound up making $100 on this part of it. Okay. And then the next spread we did was same thing. Okay, another $100 gain. All right. So we're up $200 at this time. All right. As it was going up, I took these off because once again, the 79 calls moved faster than the 80 calls. So when I took out the original 10, that gave me less exposure to the upside. Okay. I did it again. Same thing, less exposure to the upside. Okay, plus $200 in our pocket. Being defensive in this case because it started to move against me. All right. And then we were left with a position of long 13 of the 880 calls and short 21 of 79 calls. All right. This is when Facebook made its big move. All right. And had I bought a couple of these 79 calls, so we had more of a 13 by 8 or maybe 13 by 7, so it'd be roughly 1 by 2. We'd have 2 calls with long for each one were short. As because it shoots up like that, it kind of hurts us. Okay. So I did take it off at the 13 by 10, and we lost $258 on this trade. Okay. So net, we lost $58 on that. Okay. So we started out the first 2 halves, made 100 apiece, up to $200. Just think if I had just bought a couple more of these, okay, that's a, shoulda, woulda, coulda, of course, but that would have been about $550 savings. So instead of a $58 loss, it would have been about a $500 gain, okay? But the key thing is we didn't get rolled over, okay? That's the key thing. You want to be, after doing this for decades, a popular saying is it's better to be spread than dead, okay? Because when you're spread, if things go against you, there's a limit to how badly it's going to go against you, right? You could still lose money. That's why you got to keep adjusting, keep working it. Okay. Okay. First off, I'm going to give you a couple real examples that you can look at right now. Okay. All right. So we're going to look at a couple stocks that are having earnings. All right. We'll look at Apple. Okay. We're going to look at options that expire on May 1st, okay, because I believe Apple's earnings are on the 27th, okay? So these positions, too, you want to slap them on the day of where the earnings is going to be disclosed after the close or before the opening. Okay? So something like this, when I was talking about implied volatility before, we see the implied volatility for the at-the-money options here, the 126 calls, about a 35.13. Okay. And the 125 options, 30. All right. So what you want to do is sell something that it's going to be there. So we look at the current ones are released, and it's about 35. And we go up about 30. So it's 31 versus 35. That is why you wait, because as it approaches that earnings cycle, the implied volatility starts rising, okay? And you can capture that. So would this be a great one to do at this time? Not necessarily, okay? Well, what we are going to show you, we'll show you a couple others that are having earnings this coming week. In fact, IBM, I believe, is having them on Monday. Okay. Okay, so there we go. Okay, so we're going to look at the options that on the first that expire a week from this Friday. Okay, we look at the 162.5 calls at 26 implied volatility, 24 implied for the next one, and okay. So the front month we would look at are these, okay, and stocks currently trading 162.5. We might look at the selling the 182.5. We'll go to the next one up. So we look at selling the 162.5 calls. That has a delta of 50. Okay. When I say it has a delta of 50, that means these options are trading at about $3.50. A delta of 50 means if the stock goes up $1, it will not be $3.50, it'll be $4. Okay. So we have these 50 delta options. Okay. Or the 162.5. So get out your piece of paper there. Sell those. Okay. And we look at the 165 calls. Okay, a 40 delta. All right. So as these go up, they'll only go up 40 cents versus 50 cents for the others. So we're going to want to buy 5 of these for each 4 that we sell the others. Okay. So let's just take a look and see how that graph looks for that. Okay. We're going to create a spread. And we're going to look to buy 25, okay, of the regular maize. Okay. Now you see where this leads to. Okay. If this on April 24th, if it's right there at that sweet spot, that 162.5, we're going to look to probably get a little over $6,000 in profits. Okay. And if it starts going this way, it's going to be the profitability start losing the profitability. Okay, and if it gets up to the underlying price about 168, that's when you start to lose money. Okay, so even before it got there, we'd probably be making some adjustments. But you can see how this works. So it starts out just like this, but this kind of soft thing like this becomes peaked because what's happening? These April options are declining in value. Okay, if it gets to somewhere like here, then what do? We do something like the example we showed you before, the Facebook trade. We'll buy some kind of call spread that will give us, that will benefit from an upward move. Okay, so as we're losing on this, we're making on the other. Okay, those are the adjustments that make you money. Okay, they give you those nice little returns, so that at the end of the year, you're ahead of the game. Okay, so here's one example for you. Next week, Yahoo is another one. Okay, so we look at, that'll be expiring next Thursday, but I believe the earnings is next Thursday, 563. Okay. We could look at the 46 calls. Okay. That has a delta of 42. So once again, this 50 cents, if it moves a buck, it's going to be 92 cents. All right, if it moves a half a buck, it's going to be 71 cents. Okay. And this is how much it's declining at, about 4 cents a day, and that picks up speed as it goes along. Okay. So we'll look at the 46 call to be short. Okay. With a 42 delta. And we look at the 46.5 call. Okay. That also has a 42 delta. So we're having that 50 cents we're giving up, and we're going to pay about $1.05 for it. Okay. We'll take a look at that, see how this works out. We just put it on 25 times, for instance. All right. And once again, we see this, you know, a TP-like thing. All right. So this is not very little money we're putting out on this. So we make about 1,000. So we could actually, because of the small margin, we could actually pump this up to a 50 lot. Okay. And a lot of these brokerage firms now, you don't have to worry about the cost so much, because a lot of times you can put a 50 lot spread on and they charge you per trade, not per contract. Okay. So we could double the size and we could potentially make $1,900 on this. All right. If it starts moving like this against us, okay, then it's not going to be so good. All right. But we have a lot. It's actually it'd be terrific if it stays in this range, okay, because the higher implied volatility because of the earnings. Okay. All right. And let me see what else we have here. And that's going to be 423. So that, okay, so we're going to look at the April 24th. They will still be around during the expiration. The regular Aprils will have expired. Okay. So 84 calls. Okay, they're currently like about a 42 delta. Okay. And we'll go out to May. And we'll look at the 85 calls, okay, that are about a 40 delta. Okay, so we did this 25 times, so we'd maybe do it 30 by 28, something like that. So let's take a look at that. So we're going to look at the the 84 calls we're going to be selling, and we're going to be buying the 85 calls. Okay, so here it is at 84. Could make over 5,000 on this trade. Okay, we have a pretty wide berth too. Okay, up to 89 on this side and down to 77 on this side. Now, part of that is because it is earnings that's coming up, and sometimes it will be like a $10 move. So it getting below 77 would not be ridiculous. Okay, if it got down to 74, even if it got down to 74 here, we're only showing a $670 loss versus if it goes up here at, close to 5,500 gain. All right, once again here, up at 93, all right, which is a $11 move to the upside, about a $933 loss. With a stock at 91, still only 400. So you'd have to make a big gap not to. If it does, just sits there, you could make a killing on this. Okay, that'd work out great for you. All right. Once again, roughly this, just a slightly more deltas on the option we're selling versus what we're buying. So we bought a couple extras to compensate for that. Okay. All right, so those are just a few of the examples. And we could run by one more. We'll look at Pepsi. All right. Now, Pepsi is a stock without a lot of high implied volatility, so it doesn't really move that much. But even that, you could even look at a possibilities here. Okay. We're looking at the 97.5 calls with about a 40 delta. Okay. And then we go into May. We look at a 42 delta roughly, so let's say we do it 30 times. We just to be, and here we have, okay, almost $1,000 we can make the goes. That's moving really against us. Yeah, that'd be, but how frequently does Pepsi do it? Not that often. So this is actually not a bad risk reward right here. Okay, when we take into account how much Pepsi moves. All right. Okay, back to our slideshow. I just wanted to tell you about our on-demand webinar series we have. Okay. Option Trading 101 and Option Trading 201. Okay. 6 hours of option trading videos. That's a tremendous bargain for you. All right. If you're new to option trading, this is terrific. Okay, because they normally go for $97 a piece. All right. But we're offering for people from this who've gone there, just go to http www.optionsauthority.com/learn. Okay, just write that down right now. Okay. So 6 hours of those option trading videos for just 49 bucks. All right, that's a great bargain for you. All right. And what do you get with this? You get 6 one-hour online videos. Okay, so 6 separate ones. You don't have to sit there for 6 hours through all of it. You get hour a piece for 6 of them. You control the pace. Watch at your leisure. You can on your train, with your little headphones on the way in, or your car. You can listen to it, or at home, whatever you want. Unlimited access. Okay. In Option Trading 101, you learn the market fundamentals needed to start trading options. I know a lot of you people here are futures traders. It's a wonderful head start for you to get to just get the basics. Okay. You get the basic option strategies such as long and short calls, puts, straddles, strangles, covered calls, and protective puts. Okay, so this is the real meat of the basics for you. Okay. In Option 201, you master the mechanics of the multi-legged spreads that professional traders use. Okay. And you know, the butterflies and the vertical spreads, it's going to be really terrific for you. Believe me, 6 one-hour online videos for just for that small amount of price. Okay. There it is for you. Okay, 49 bucks. Once again, http optionsauthority.com/learn. Okay, 6 hours of it from the beginning to the end. Okay.